It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And again, smartest guy in the room, Michael Becker.
Hey, Paul.
So Michael, who owns, make sure I have this correct, 4,600 doors?
Yeah, we've done 4,600 units now. Yeah.
Amazing, and has done just a great job with his investors and collected over $85 million of investors' money that has trusted Mike and his group at SPI. So he is the smartest guy in the room. Today we have a question for Mike, and that question is, what should I be aware of when applying for bank financing? So Mike, what should you be aware of?
Seemingly, we've talked a whole bunch about Fannie Mae and Freddie Mac because that seems to be almost probably the majority of the business we're doing anymore. But that's not all we do, and that's not how it used to be. My background is I'm a community banker, and then I worked at a large national bank, Wells Fargo, for many years. So I was kind of more on the traditional side of the banking when I came over into Old Capital and left the banking industry and went onto the mortgage brokerage side. But really some rules of thumb, I guess, when we put it that way. So a couple of rules of thumb that people should keep in mind when we're thinking about bank financing. So think like community bank or regional bank financing. So first and foremost, not all lenders are the same. Some banks just don't like real estate. So some banks just only want to loan on what we call C&I, commercial industrial lending. So kind of think of like receivable lines of credit or, auto loans or mortgage loans, things like that. But not all banks really like commercial real estate lending. And then banks that do like commercial real estate lending, not all banks like apartment loans. So some banks only like to do retail and churches, for example, which we don't like, but that's what they particularly care for. The other ones, not all lenders like these older properties need to be rehabbed or repositioned. Some of these community banks just don't understand the value add component to it. They just want deals that work and make sense kind of out of the gate. Another one is that not all lenders like non-recourse loans. Pretty much virtually the vast majority of commercial and community banks will require personal guarantees. That's a very common thing that they have on these regional and community bank loans, is to have one of the principals sign recourse on a loan. And then not all lenders like the certain parts of towns that you want to invest in. So some of them kind of are like truly community banks that want to loan in their community. And another thing is a lot of these community banks are also kind of biased against out-of-towners. So, when I was a community bank, we didn't like people coming from California to buy properties in Texas because, the board of directors of the bank had a bad experience. And so we just didn't loan for out-of-towners that came into town. We wanted someone with like a local presence on properties in the local market. Another one is not all lenders will give you maximum leverage to do the renovations if they do it. So maybe they won't give you a full 80, maybe it'll be 75, maybe 70% leverage when they're doing these deals because it has a certain risk component too. And then finally, not all lenders will amortize the loans all the way up to 30 years. Most community banks cap them at 25, and then some of them even will cap it at 15-year amortization. So it really kind of hinders the cash flow in these deals. So those are some of the rules of thumb that what these banks won't do. At the bank, your bank officer is usually not the decision maker. What you can do as a borrower is kind of help him or her build a case for their credit committee to approve the loan. The loan officers are really just kind of the front of the deal. They're the salespeople, and they kind of help solve the problems. They don't necessarily have signing authority. So those are some of the rules of thumb. Paul, what else do you have to add to that?
One of the things you brought up, that not all banks are real estate lenders, and not all banks are going to like you're part of the town on these transactions. What I found on credit committees is that, again, these small community banks may have a couple business people on the board that are part of the decision tree, or they may have somebody that actually works for the bank that is on the decision tree that may have never done an apartment loan before. So just be advised that you may want to ask when you go into the bank, find out the last time they had approved an apartment building first, and if they approved the apartment building, where it was, what type of transaction it was, and where the property came in at the approval. Was it at 65, 70%? You just don't want to have a long conversation with somebody that just is not in that business. It does say bank on it on the top of the building, but it's not. They're really not a real estate lender.
Yeah, a couple other things too. When I was a community bank, some of the general rules of thumb that I had, and every bank's a little different, but when we're looking at trying to put a deal together, which is a little different than what we normally talk about, the Fannie Mae and Freddie Mac loans, is what we do a lot of, is these banks want to have the people signing on the loan have the majority of the money in the deal. So, for example, at Wells Fargo, was our credit policy there that we had at 51% of the ownership sign recourse. So people actually had to put money in the deal that signed on the loan. They didn't want one person with a big balance sheet but only have 5 or 10% ownership sign the loan, and everyone that put the bulk of the money in the deal not sign the loan. So that was a rule that we had there. And every bank's a little different, but generally speaking, they're going to have, a decent chunk of the cash in the deal sign recourse on the loan. Another thing that we always talk about when we talk about Fannie Mae and Freddie Mac is that we want to have net worth of the guarantor or the guarantor pools to be equal to or greater than the loan amount, and post-closing liquidity about 10% of loan amount. Well, kind of the rule of thumb I like to use is that net worth test is about the same. You want to kind of have the guarantor pool have about their net worth to be equal to or greater than the loan amount, kind of at minimum, but the liquidity they really look for is a little bit higher typically. So it's more like 20 or 25% of the loan amount post-close liquidity, because when they make these loans, these community banks will make a little bit hairier type loans, not quite so stabilized. They'll take a little bit more risk on the deal because they have a personal guarantee to lean back on, where the Fannie Mae and Freddie Mac is a non-recourse loan. So they only have the property really to lean on. So that what the community bank does is they want to kind of hedge their bets. They want to make sure that they have someone that has some liquidity to stand behind and support the deal if there's an issue, and certainly would be obligated to support it by signing the recourse. So the more liquidity and the more net worth, certainly the better the chances of getting approval at a community bank are.
That's right. And liquidity is a big misnomer because it's stocks, bonds, or cash. That's something that's in your name. It's not 401ks. It's not IRAs for the benefit of you. That's not part of liquidity. Equity into a property, whether it is your equity in your house or equity in investment properties, that's not liquidity. Let's just say liquidity is liquidity.
Yeah, and then another quick thing too, just when we're looking at these deals, especially on the refinances, Fannie Mae and Freddie Mac are much more comfortable giving cash out on the refi in and above the amount of money that you put in. These community banks, they really want you to have some money in the deal. So even if you're coming in, bought it for cheap, renovated it, increased the value, by a dramatic amount, it's really hard to get a community bank to give you more money out than they want you to have than what you have in it. They really want you to have some actual cash in these deals.
It's almost like in the movies, is that community banker makes a bad loan, he could jeopardize his career.
We always would joke and say, I don't want to make a career loan. And that was what we would say around the bank. You don't want to make a career loan. And that's really what it is. And these community banks, like Paul alluded to, they have, board of directors, and it's usually like the guy that owns a local car dealer or a prominent lawyer in the town. They're the shareholders of the banks, and they sit on the credit committee and make decisions along with like the bank employees as well.
So what's coming on with the Old Capital Group?
Yeah, coming up here pretty soon on June 7th. Coming up real quick, we're going to have Amy Morgan from CBRE Appraisal come and speak at the Old Capital Speaker Series. So it's June 7th. Starts at 6:30. It's at the Grapevine Convention Center in Grapevine, Texas. The last event we had was Dr. Mark Datzauer. I think we had almost 400 people at that one, Paul, if counted right.
That was a big one.
A lot of us. So this one should be several hundred people as well. At the Grapevine Convention Center, Amy's going to talk about kind of how, from an appraiser's perspective, how do you continue to add value even though we're late in the cycle, and some ways from an appraiser's perspective to increase the value into these deals. It's also a great networking thing, almost even more than the content that is going to be great from Amy. It's really the opportunity to network with a bunch of other people that are in the business and in the industry, and we even have a cocktail or two afterwards if you're so inclined over at a local restaurant around the corner. So it's a great event to go to as well. And one of the things I would certainly encourage everyone to do is, if you want to find out some more information about that, you certainly go to the oldcapitalpodcast.com. We have the information up on our website, as well as there you can sign up for our Multifamily Financing 101 white paper. 15 pages kind of goes through some of these things that we just talked about on this podcast about kind of the bank financing guidelines kind of at a high level. It's certainly that plus a lot more information than we covered here today. And also you can sign up for our sample due diligence checklist. So it's what I ask for when we're putting LOIs in on properties.
So one of the things you mentioned too, if you do like the podcast, don't forget, and we really would appreciate it if you go on to iTunes and leave a 5-star review. That does help us, gets us better clients, even though we have great clients, great people to tell stories. We definitely would like an iTunes 5-star.
One thing I think that we have coming up, and we have a save the date, right, Paul? Give me put out the save the date.
Just save the date for October 5th. We're going to have a big event on October the 5th. We're not going to kick it off yet, but put it on your calendar, back of your head. in your tickler system, October the 5th. It's going to be, well, I'm not going to even talk about it yet. So October 5th, put it down the calendar, just put Old Capitol, save the date, and then hopefully we'll see you then. So thanks for coming in. Michael Becker, Paul Peebles here. Thanks for listening, and we'll talk to you soon. Thanks.